All right, we are pushing towards that record on the S&P 500 futures higher. 30 minutes until the start of the cash trade. I'm Matt Miller.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, the chips are up. Micron issues an upbeat report while NVIDIA reclaims the throne as the most valuable company in the world. And as we approach the second half, Barclays sees further gains ahead for stocks, while Goldman is betting on more volatility in this market. Plus, it's game on for bank stocks. Wall Street firms are set to have a revival thanks to looser regulation and a rise in deal making, as well as this elevated interest rate environment. Katie, what are you watching this morning? Happy Thursday.
Happy Thursday. It's almost Friday. Let's start with the chips because Micron, as Matt said, its earnings topped estimates. You had the AI equipment maker give a rosy forecast as it looks to expand its reach to EV and gaming chips. Shares only up about 0.8%. They were up higher initially after the numbers, but came in a little bit as the call went on.
All right, so we're going to focus in on the rise, the rally in tech stocks. NVIDIA obviously leading the pack there, on track to extend gains after closing at a record high. It's added nearly $1.5 trillion, with a T, trillion dollars to its market cap since April. You can see in the pre-market it's up 1.25% and is now worth more than $3.8 trillion, overtaking Apple and Microsoft and everybody else as the most valuable company, Katie, in the world.
Yeah, there you have it. Let's stay on these two giant chip makers. Bloomberg Tech co-host Ed Ludlow joins us now. Ed, let's start with Micron, because it was a rosy forecast, but it wasn't exactly runaway growth that they were predicting, and maybe that explains the somewhat muted reaction in shares.
Yeah, I think a big part of the forecast for the fiscal fourth quarter on sales, and remember, their sales, its revenue, was pricing. So high bandwidth memory is everything. Clearly, demand for high bandwidth memory is there, but it's also the situation that they are capacity constrained. And so there was this endless discussion and back and forth and a number of questions from the sell side on the call about pricing and how they've used that. Because remember, in the prior quarter's earnings, it had impacted margins. Now they were able to use it to deliver some outperformance on the top line. But very much the story from Micron is simple. The AI demand is going to grow faster than the historic demand for DRAM and NAND that go into computers and smartphones. And that's how they're repositioning this company.
How much competition does Micron face? Ed, yesterday we were talking about the fact that, they're not the only player in town.
Yeah, it's really key to understand the field. So there are essentially three makers of high bandwidth memory. In the United States, Micron is the biggest memory chip maker. But in Asia, you have SK Hynix and Samsung. And what is happening right now, if you believe that we are still in the relatively early innings of building out data center infrastructure, where you have high performance GPUs or AI accelerator cards that need high bandwidth memory, lots of hyperscalers, cloud computing companies are validating the performance of each of those. And it was really interesting. This is why we talk about NVIDIA in this context. Every time Jensen Huang name checks one of these names, the stocks react. But that is because NVIDIA is looking at all of them to see which marries up best with their GPUs.
All right, Ed, thanks very much. Ed Ludlow there is going to go off and prepare for his tech show. Bloomberg Tech kicks off at 11 a.m. Definitely a show you want to watch today. And really, I mean, lately, these tech stocks have been powering everything again. As we said, NVIDIA has added $1.5 trillion since April.
It's
in market
amazing.
Cap.
It's amazing. And you make a good point that, okay, we're near record highs, but if you really decompose the breadth of this rally, it comes back to big tech, which isn't a bad thing when you think about index math, but you could get concerned about the health of the rally.
Let's bring in Vijay Rakesh. He is Mizuho Securities senior analyst joining us now. He has an outperform rating for both Micron and NVIDIA. And let me ask you, Vijay, about the first about the smaller company. We're talking about Micron because of the earnings. As Ed mentioned, they do have, they have a lot of competition, and as Katie was talking about, it wasn't sort of the knock the cover off the ball forecast that Wall Street was expecting. How do you see it?
Yeah, thanks for having me on, Matt. I think this is just the beginning for Micron. I think I would say the competition for Micron is actually less. When you look at the high bandwidth memory for AI servers, they are really two suppliers, Micron and Hynix. Samsung has yet to get qualified, and we see that continuing to be a challenge for them into next year. So we think Micron's high bandwidth memory for AI servers will probably grow 100% year on year into 2026. And if you look at the earnings profile, earnings could almost double from current levels over the next 2 to 3 years. So there is still significant earnings leverage left in Micron, significant HBM growth, which really is dovetailing with the whole AI market growth. So that will be a massive tailwind for them as you look out into 26, 27. And combine that with NAND, that is also seems to be in a very constructive mode here in terms of NAND pricing going up. So that will be a tailwind for them as well.
So I hear what you're saying, that when it comes to the fundamentals, it certainly seems like the stars are aligning in your view. Let's talk about valuation a little bit here, because this stock has come a long way very quickly. It's up 51% through the close, I believe. I mean, when you think about just the trajectory of shares, I know you have that outperform rating, but are we due for maybe a breather here?
Yeah, I mean, to that point, obviously, Katie, as you mentioned, the stock is up 100% in the last 2 months. So you're seeing a little bit of a, kind of a consolidation here. But that said, I think what we see broadly in semis is, for Micron specifically, is a massive tailwind in HBM. But that said, for semis, what we have kind of highlighted is also potential for some tariffs coming through in the next couple of weeks, especially with Section 232 from the Trump administration trying to bring manufacturing back home. So that could be a little bit of a headwind challenge for the broad semi group in general. But outside of that, if you look at what's happening to AI servers, HBM content on AI servers, HBM content on ASICs, custom ASICs from Broadcom, etc., it all is going up and up to the right. So we continue to see that's the tailwind for Micron.
Vijay, you have a massive coverage universe, not just the Magnificent Eight, but I even see General Motors in here. What is the stock that you're most excited about? What is the story that when you wake up in the morning gets you into the office?
Oh, there's a long list, but I think I would definitely count NVIDIA, Broadcom, Micron in those names, as well as Credo Semiconductor, which has been one of the enablers in the data center there. But also, I think the analog group in general is starting to find a bottom as auto, industrial, and consumer demand starts to bottom out and stabilize in the back half. So I would say those should be the buckets that investors should be focused on into second half and 2026.
All right, Vijay, really appreciate your perspective on the heels of those Micron earnings. That is Vijay Rakesh of Mizuho Securities. Let's take a look at some of the single stocks moving this hour. It's not all about big tech. It's not all about the chips, even though that's some of the most important stories in the market right now. But let's get more with Bloomberg cross-asset reporter Isabel Lee. Isabel, what's going on underneath the hood?
We have to look at Walgreens. So the company reported profit that beat expectations. So this is a hopeful sign as the company prepares to transform back into a private company. So adjusted EPS came in higher at 31 cents. Revenue was also higher than estimates at $39 billion. So shares are edging higher, but just by 0.7%. So Walgreens is the second largest U.S. pharmacy company in the U.S., and it's set to be purchased by Sycamore Partners, that's a private equity firm, for $10 billion by the end of this year. So Walgreens is also in the process of selling its health business, Village MD. So next, we're looking at McCormick. So we can see shares here also jumping. So McCormick is a flavor and spice company. If you don't know this, it means that you're not in the kitchen often enough.
We all know McCormick.
Okay, good. So it reported EPS, the top estimates, and the company also reaffirmed its top line and bottom line and profit and sales guidance. It is worth noting, though, that the company's outlook is based on tariffs currently in place. So they really haven't factored in any potential tariffs that may arise.
It is a $20 billion spice company, and every time I'm in the grocery store, I have to ask myself, is this cumin better than this cumin, or is all cumin the same?
It's not all the same.
No?
I always pick the ones in a jar, in a glass container, because I like to waste money like that.
I just have really strong brand loyalty. So
what is your brand?
Well, I can't say that on there. Not investment advice.
You'll whisper it to me later.
Yeah.
Okay.
Nike also, speaking of brand loyalty,
Nike is reporting after the bell today, so investors will be looking at tariff impacts, China business, and of course, new products. So Third Bridge said that they will be looking at how management will come up with new products. We have Bloomberg Intelligence saying that they will be focusing on Nike's women business, especially after that Kim Kardashian partnership being pushed back. And Jefferies in general is just optimistic that Nike's clearing off of their inventory will pay off. So
this is good. How do they work on your feet, Isabel?
No, I use Adidas. Adidas?
Adidas, yes.
I say Adidas because,
Adidas.
You know, we're in New York.
But it's Adi Dassler's company.
In any case, I'm a Hoka gal, so I don't know. Nike has a lot of issues. You think about the new CEO, Elliott Hill. So he came in with the goal of making Nike cool again, which is hard. That's a fundamental problem.
I mean, Jordans will never not be cool, right?
I know, but in terms of, they kind of lost the sneakerhead community a little bit. But then you pile on a trade war, supply chain issues, tariffs, all of that on top of Nike. And it's been a really, really tough road for this company. So we'll have to see how that goes. Isabel Lee, great roundup. As always, looking forward to those results after the bell. Let's talk about where we stand about 20 minutes before the opening bell, though. The S&P 500 up about 0.2%. We're very close to record highs, I believe.
Yeah, I mean, this is the futures picture, right? But yesterday we closed unchanged at 6,092.
Like perfectly unchanged.
Yeah, almost exactly, right? We were down 2/100ths of, 2/100ths of a point.
That's a sneeze.
But 6144 is the number we're looking for. So if we're up 50 points, that's it.
That's all you need, just 50 points. We'll see if big tech can get us there. You do have the NASDAQ 100 higher pre-market as well, even though it seems like Micron not exactly really throwing its weight in the ring. Like you said, they didn't exactly knock the cover off the ball.
It's not a gigantic company, right? And there are smaller companies. VJ was talking about Credo, which is only a $15 billion company. Micron, $150 billion. NVIDIA, $3.8 trillion. By the way, I'm very excited about the next story that we're going to talk about after this break. Jefferies profit slumps on weak deal making, but Mike Mayo says it's game on for bank stocks, and Jefferies has outperformed all of the major banks on Wall Street over the past 5 years. Stay with us. This is Bloomberg. Let's get to high interest, a look at what's making headlines around the world. President Trump takes aim at Fed Chair Jay Powell. Again, the Wall Street Journal says Trump may announce Powell's replacement as soon as September. The president said yesterday he has 3 or 4 people in mind for the job. Powell's term as chair doesn't end until May 26, but the idea is to put pressure on him and maybe distract the street a little bit with a new kind of shadow Fed, not like Alan Meltzer. Shell says it doesn't plan to snap up rival BP. The company denied earlier reports saying it's neither in talks nor has it approached BP for a takeover. Shell's statement triggered a 6-month bidding block under UK takeover rules. And Palantir short sellers are bailing as the stock continues to climb. Shares of the software maker continue to rise thanks to fervent retail traders and heightened geopolitical tensions. Palantir's stock has rallied nearly 300% since last October, making it the best performer on the S&P 500 this year, which has kind of gone under the radar to some extent, Katie.
A little bit. We talk about it now and again, but certainly not as much as NVIDIA, for example. Let's talk about Jefferies, though. I know you're psyched for this story, Matt. Jefferies shares falling in pre-market trading after reporting a decline in second quarter earnings. Market turmoil really weighing on deal making in a big way. Let's talk now with Bloomberg Intelligence financials analyst Neil Sipes. So you can see Jefferies shares down about 5% pre-market right now. I want to put this into context, though, because you take a look over the past 5 years, the stock is absolutely crushing it, up 370%. But this year, it's really struggled, down about 27%. And you think about the effects of this trade war, this pullback that we've seen in deal making, it seems like Jefferies has arguably been hit the hardest.
Yeah, and I think that speaks to what this business actually is, which is much more heavily geared to the investment banking, the advisory underwriting landscape, where we entered 2025 in a really robust scenario where we had pretty lofty expectations for the deal-making rebound across all businesses. What we've seen at Jefferies, and I think what explains a little bit of what you pointed out, is we've seen some of the steepest revisions in estimates over the past handful of months, which generally relates to the fact that we had what we experienced in April, where you have uncertainty and volatility. That's the enemy of M&A and deal making. So ultimately, the expectations for a really robust 2025, it feels like those are getting pushed out further into 2026. And I think that's what we saw a little bit with Jefferies' results yesterday is, yes, the profit was hit, the stock is down as a result of that. But the rosier second half outlook, I think, is something we're going to be looking for as we sort of see the materialization of some of the momentum in capital markets.
I'm so excited about this story because I did like 10 seconds of research on it before I came out here. And we just showed the chart. It's beat all the big Wall Street banks, even if you put, Shanali gave me the cap light comps that I should be running. So it's beat all of them too, except for Evercore ISI. And then I saw Mike Mayo's quote, which I thought was great. So he says, right now, you have a triple play when it comes to banks. So long as there's no recession, it's game on for bank stocks. Giddy up. Anytime someone says giddy up in a quote, I'm listening, I'm paying attention. He says it's because of deal making, because of loosening regulations, I guess deal making to come, and it's because of the high interest rate environment. Do those three things hold, and is that helpful for Jefferies, which had kind of a weaker deal making picture thus far than we would have wanted?
Yeah, I mean, the statement definitely applies to more broader traditional banks with the lending side of the business as well. But for Jefferies, again, it's going to be much more of that investment banking focused. And I think his quote rightfully caveats assuming no recession, right? Because the economy is always going to be the wild card. And as you think about that, I think from the broader banking landscape, you have the sort of constructive outlook for both key revenue sources, the non-interest income. That's going to be things like wealth fees, capital markets, trading, and then net interest income. Yes, we have easing rates generally and gradually over the next couple of years is the expectation at least. But those are still at rates that we haven't really seen in the post-Great Financial Crisis era. So you can end up in the scenario where the easing rates are actually supportive of loan growth, relief on deposit costs, et cetera. That can kind of create that sort of giddy up scenario, I guess, if we're going to use his terms.
Before we let you go, I do want to just focus on Jefferies because it feels like there's a lot of ifs here. You mentioned if there's not a recession, if we see that growth and that comeback in M&A in the second half, then that could stack up quite favorably for Jefferies. If that doesn't happen, it seems like this ugly year, though, could get even worse.
Yeah, and I think a lot of it, again, is unfortunately going to hinge on sort of the macro economy, which is, of course, nearly impossible to forecast. And I think that's really the story with Jefferies here is it's a market share story. You've seen them add senior bankers. Their headcount is 50% higher than the record year in 2021, right? So if you sort of look at a normalized run rate for the business, it's much larger than it is today. But of course, you need the environment to cooperate. So as we sort of look forward, we're going to be looking for the momentum in the capital markets underlying the business. And what really the expectations are underpinned is secular profit expansion as well as cyclical profit expansion. So we have to have both to sort of see that business fire on all cylinders. So second half awaits.
All right, Neil, great to have you on the program. Thanks very much for joining us. Bloomberg Intelligence analyst Neil Sipes there covers financials for us. Coming up, strategists say AI and stagflation are the big themes going into the second half of 2025. Feels like we've been here before. Economist and market strategist Lauren Goodwin joins us to talk about that next. This is Open Interest.
Welcome back to Open Interest. Barclays says that fears of foreign investors pulling out of U.S. assets are overdone as attention shifts away from tariffs and taxes. Strategists see AI as one of the strong drivers of corporate earnings in the coming quarters. We've certainly heard that before. Meanwhile, Goldman Sachs strategists anticipate higher stock volatility in the second half of 2025 as stagflationary shocks threaten the current market rally. So two sides to that trade. Joining us now at the desk is New York Life Investments economist and chief market strategist Lauren Goodwin. Lauren, great to see you.
So nice to be here.
So we are days away from the second half. You just heard two different cases for how it could go. When you look into your crystal ball, how do you see the rest of 2025 shaping up?
I'll be completely honest with you. I have a view, but it is not reflected in our asset allocation. I think this is a period where investors have pretty balanced risks. And what the market is focused on right now are the upsides. And we see that from the just incredible V-shaped recovery we've had since Liberation Day. So investors are seeing the deregulatory impulse of the Trump administration finally moving forward. They're seeing the idea that tariffs may be lower than was threatened just a couple of months ago. They're focused on good news. And I think there's reason for that. These are upside potential positive catalysts for the market. But the reality as well is that tariffs are likely to be higher than they were just a couple of months ago. And that's and the policy environment is causing businesses and consumers to really pull back on what they're looking at for the second half of the year. And so we're not expecting a overwhelmingly negative scenario, but it's one where a very broad and boring look at quality and diversification is really what makes sense from an allocation perspective.
All right, we have to go to break, so I'm going to save my eco questions for you, but like we had a slew of data today, right?
We did, a big
so
stack.
we had, for example, goods exports down 5.2%, right? GDP, was it negative 0.2? No, it was negative 0.5. So it seems like the left tail is something that this market may want to be paying attention to. Continuing claims,
PCE.
higher than anticipated. PCE, higher than anticipated.
There you go.
A lot of not fantastic news. Lauren Goodwin stays with us to go through that. She is an economist as well as a market strategist. And futures?
And futures, they're green right
The
now.
market doesn't care.
Market doesn't care. Looking past that stack of economic data that we got, looking past the fact that we have a lot of deadlines coming up when it comes to taxes and tariffs. We'll walk through all the opening action up next. This is Open Interest.
We are moments away from what could be the start of a trading day on which you see an all-new, all-time record high. I know I said that yesterday, but it does look like we're in sniping distance of it. Right now, futures are up 0.3% on the S&P. NASDAQ futures are up 0.4%. We only need to go 52 points to get a closing record on the S&P 500, and this market wants to rally. You hear the opening bell on the New York Stock Exchange. Talos Energy ringing the bell there. They're pumped, but their shares have posted a negative return over the past 5 years, so they may want to get back to work. Meanwhile, here at Popular, which is a Puerto Rican bank, this guy, Ignacio Alvarez, is retiring, and he should be celebrating. He has more than tripled the shares of the bank since he took over as CEO in 2017, and more than quadrupled since he moved into the C-suite as COO in 2014. So that's an awesome way to go out.
Yeah.
Ignacio, great job, man.
Good on you. Enjoy retirement. Let's talk about Micron.
Yes,
a
let's
little
do
bit
it.
here. Micron shares up about 0.6%. Earnings topped estimates, but when it comes to the forecast, the AI equipment maker, they did project growth, but it wasn't runaway growth. So maybe you're seeing some of that enthusiasm drain out of this stock. I will note that Micron was up 51% through yesterday's close. So stakes were certainly high. They didn't necessarily disappoint, but maybe it just wasn't enough. Matt Miller, you can see shares trying to decide what to do at the opening bell.
Yeah, we don't need them anyway, Katie, to push to record highs. I mean, they make a difference at $150 billion. When I was a kid, that was a massive market cap, but NVIDIA is worth $3.8 trillion, extending gains after closing at a new record high yesterday. As we've been saying today, the market cap has added $1.5 trillion. The company has added $1.5 trillion in market cap since April. That's massive. I mean, there are only like 5 companies worth that much or more on the entire S&P 500. So we've seen these huge moves, and I guess it's because the economy continues to look strong. We don't get the recession. We don't get the stagflation that people have been, in and out of forecasting for the last couple of years. We are back with an economist at New York Life Investments. She's also the chief market strategist. Lauren Goodwin, still with us here. Lauren, I want to just pick your brain about the eco screen that we saw today. On the Bloomberg terminal, you can type ECO Go, and you see today just a ton of data. We had imports and exports. The trade balance is huge. We had GDP. It's down to negative 0.5%, worse than we had anticipated. Core PCE, as Katie mentioned, is higher than we had anticipated at 3.8%. Continuing claims are higher. Like, what does this economy look like to you?
Well, first of all, I live with ECO Go, so
Yeah.
that, it's like just a regular part of my day. If we take a step back and look at the last 6 months, what we're seeing in the eco data screen is completely expected, and underlines the point that if we didn't have some of the economic and tariff-based, inflation-based risks that we have looking forward, there would be a pretty clear cut for the case for the Fed to be cutting closer to neutral already. So the employment environment has been normalizing over the last couple of years. I believe we're continuing to see that with some softness, but certainly not recession indicators at this point. And prices are just starting to reflect some of the purchasing that companies would have needed to be doing over the last couple of months. I think that trend is likely to accelerate here as we look forward and companies get ahead of their Christmas time or holiday time borrowing, and so or purchasing. And so this is a period of time, let's call it the impasse, the summer impasse, where we're not seeing the economic risks out there borne out in the data, but we'll continue to see them accumulate.
Well, to that point, Lauren, I'm taking a look at the notes you sent over to our producers. You write that your investment strategy remains patient, diversified, and transition-oriented. I haven't seen that phrase used before when it comes to a portfolio. So just walk us through what that means.
Yeah, we believe that we've seen a series of structural changes accelerate over the first part of this year, but really those structural changes are years, if not decades, in the making. The transitions I'm speaking to are the felt experience of the pandemic, giving everyone, people, governments, companies, a sense that supply chains are in many cases should be protected, right? What that means for the geopolitical environment, what that means for corporate investment. We've seen a massive crowding in of company and consumer behavior following global governments in this way. And so there are capital intensive and interesting investment trends that are unfolding now, and they require a portfolio to look a little different than it has. So that includes really more than anything, a broader look at diversification across public and private markets, and of course, geographically as well.
Is that the way to, I mean, not hedge, but avoid, a left tail coming up and biting you in the butt? Because it does seem like, everybody wants this market to rally. And like yesterday, Goldman Sachs said, there's so many low quality stocks that are riding this wave up that if we have a downdraft, it could be a thud.
Yeah, look, we've seen such a pronounced rebound in the U.S. equity markets, in particular since Liberation Day. And at those valuations, investors have to ask the question, are the risks ahead so balanced to the upside? And I'd argue that the risks are balanced, but perhaps not so optimistic. And so if you're looking at that valuation profile, your opportunity set might be a little bit different. From our perspective, we're taking gains in equity, deploying them in credit, and we can talk a little bit about what that looks like. But we're also looking at an equity market profile in the U.S. that might benefit from some private markets exposure, especially in the small cap space, where we see more of an engine sort of the real economy, really, and considering also the not just structural ideas I've mentioned, but also the cyclical reality that other parts of the world are cutting rates faster than we are, playing into industrial and financial sectors in those other countries.
You mentioned that you live on EcoGo. I've been looking at INGO, which is the Bloomberg Index browser. So for the last, 5 or 10 years, maybe 15, nobody wants to talk to the fixed income person at the cocktail party, right? Because there's no return. And now it's amazing. I mean, you're looking at massive returns. Year-to-date returns for Treasuries, 7%. Plus, you get to clip the coupon.
It's funny. For so long, the bond guys were thought of as pessimistic, and they're earning no yield anyway. But now they're kind of cool. And I do want to talk a little bit more about private credit. I actually caught up with the CEO of JP Morgan Asset Management earlier this week. We were talking about high yield versus private credit. His view is that private credit looks a little bit frothy right now. I believe we have the specific quote that there's a lot of money and investors investors chasing finite opportunities in the private credit market. You also have liquidity trade-offs. You take those two things in combination, and on a marginal basis, I would put my marginal dollar in public high yield rather than private credit. I thought that was really interesting because private credit has been so hot. It sounds like you see a place for it in a portfolio, but when you stack up high yield versus private credit, how does that risk reward look to you right now?
The answer to your question, which is such a smart question, lies in actually an economic reality, which is that corporate profits are so strong. We are likely to see them move lower over the coming quarters, but we're starting from an economic reality where companies have raised an enormous amount of cash and been really smart with their capital stack. That includes in public high yield issuance. And so I agree with a bullish position on public high yield. Valuations are high, spreads are tight, but if you're looking at a 2 to 3 year buy and hold, grab a couple of high quality, high yield issuers, and that's a really interesting opportunity. I'm not worried about defaults on that time horizon for high quality. But the same is true in private credit. This is an asset class that, just like in public credit, has a wide variety of operators, some higher quality than others. And if we look at an environment where you can harvest meaningful all-in yield, and that's really what you're looking at, is avoiding defaults, capturing the yield. In this economic environment, if you can work with a conservative, very quality-focused private credit borrower, that's another couple-year opportunity that I think is really interesting in this environment, and probably more interesting now if you think that rates are going to be moving lower as we move forward in the year.
Yeah, and spreads may be tight, but that means yields are high as well. So you just kind of have to choose which to focus on. Lauren, great to see you. Really enjoyed speaking with you as always. That is Lauren Goodwin of New York Life Investments. Meanwhile, back in this equity market, we are on record watch. Let's dissect this rally right now. The number you need to keep an eye on is 6144 for the S&P 500. You take a look at where we are right now, 6112. So we are very close, and good news. Breadth is very strong today. You have more than 400 names in the green right now, fewer than 100 in the red. And you take a look at what's leading right now at this moment. Good news. It's big tech. Microsoft, Nvidia, Meta, really leading this rally. You do have JP Morgan fighting to get into the top three. We'll see how that shakes out. On the downside, you do have Apple. That's not surprising to see in 2025. Equinix and Tesla as well, but still not necessarily dragging us down when you think about who they're competing with. Let's take a look at the sector level, and it will broadly reflect what we're seeing on the individual movers as well. Up at the top, you have materials, utility, energy. The list goes on. Tech down here, only with a 0.2% gain for the sector overall, but certainly more green than red. Your sole loser today, Matt Miller, is real estate, off by about 0.7%.
Is that a Mamdani thing, you think?
I don't think so. I think that would be a lot to extrapolate.
Coming up, Nvidia, Micron, and other big tech stocks soar. We are looking at I guess Micron is swinging back and forth between gains and losses, but Nvidia now worth $3.77 trillion, one of only 3 companies in the world worth more than $3 trillion. We're going to discuss what's going on at the chip makers with Bloomberg Intelligence global head of tech research. This is Open Interest.
Welcome back to Open Interest. It's time now for our top calls. Some of the analyst action in focus this morning. And this morning, we have a tech theme. Let's start with Apple getting cut over at JP Morgan, slashing the company's price target to $230 from $240. Analysts over there see iPhone 17 demand being impacted by macro uncertainty. Shares down a little bit this morning. Meanwhile, Morgan Stanley is raising its price target for Microsoft to $482. Or rather, from $482 to $530, very specific. The analyst cites upside from the company's Azure cloud service. And finally, Baird, Wedbush, and Stifel are among the firms that are raising their price target on Micron. The chipmaker did come out with an upbeat earnings forecast, but it wasn't quite enough to impress Wall Street. You can see shares kind of trying to decide what to do today, Matt.
Yeah, absolutely. And we're going to talk about what Wall Street does with tech today and this year. We got the Micron story, which is kind of did she or didn't she, right? Because as you said, a lot of people were hoping for more growth in the outlook. Mandeep Singh joins us right now. He's the global head of tech research for Bloomberg Intelligence. And Mandeep, before we get to NVIDIA, and it's almost all I care about right now, let's talk a little bit about high bandwidth memory chips.
Yeah.
It's just as boring as it was when I started covering DRAM 25 years ago.
Really selling it.
Yeah, no, I mean, I can't get hyped up about this, but Ed Ludlow from Bloomberg Tech says I should. Do you agree?
I think so. Given the print last night, 15% sequential growth for this quarter and guiding for 15% sequential growth, mostly driven by high bandwidth memory, which is a $6 billion business now that didn't exist last year. So when people talk about AI data centers as a market, and it's about $250 billion right now, if you look at NVIDIA's revenue, expected to grow to $500 billion, memory, HBM, is one of the major components of that data center expansion. And that's what they are showing in their results, is that $6 billion revenue will likely double next year. I mean, I think you will see positive revisions for the next. Yeah.
Before we had 20 megapixel cameras on our phones, right? Katie, we used to buy these digital cameras.
Tell me about these older
And you would put these little memory cards in there that you'd buy at like the drugstore, the newsstand. There used to be newsstands.
Right.
And it didn't matter whether it was from SanDisk or Micron or SB Hynix. I didn't care. It all works the same. Is that true about HBM as well?
So you're absolutely right. HBM is a duopoly between Micron and SK Hynix. But the thing I would like to point out is the market is still supply constrained. So look at the cost of a server. It's gone from around $10,000 to $270,000 with AI and NVIDIA chips. The cost of memory in the traditional server was like $4,000. With HBM, it's about $12,000 to $15,000. So it's 3x. The cost of, like, NVIDIA obviously has had the most kind of use in terms of the ASP increase, but HBM ASPs has also gone up 300%. And that's where this is a secular trend. Look, memory cycle will have its peaks and troughs. Typically, these are 7 to 8 quarters. But I expect this to continue for another 3-4 quarters in terms of positive revisions.
I am not going to ask you about an acronym right now. I want to zoom out a little bit and situate this conversation in the context of what's going on the geopolitical landscape, because we talk about trade tensions all the time when it comes to NVIDIA. It feels like that conversation isn't quite as loud when it comes to some of the other chip makers. Micron comes to mind. Do you think about what NVIDIA is dealing with? Are some of those issues idiosyncratic to NVIDIA, or are they industry-wide as well?
They are industry-wide, but the thing about AI servers and AI gear right now is it's supply constrained. Everybody wants it. And the more supply constrained it is, it gets reflected in the ASP growth of these companies. So the reason why NVIDIA's gross margins keep growing, at least they have so far, is because the market is supply constrained. To Matt's point about memory kind of being a commodity, yes, it will eventually be a commodity, but for now, HBM doesn't look like a commodity market, and that's why the pricing keeps growing.
All right, Mandeep, great to speak with you. Great to see you. That is Mandeep Singh. He is global head of tech research over at Bloomberg Intelligence. Now, speaking of trade tensions coming up, Nike investors hoping to get clarity about the delayed launch of its partnership with Kim Kardashian's Skims. Also may be curious about the supply chain as well. We'll break down what to expect in the earnings report up next. This is Open Interest.
This is Bloomberg Open Interest. I'm Matt Miller. Let's get a look at what stocks are doing right now. Just about 20 minutes into the session, we're looking at S&P 6108. If you care about a new all-time world record high, it's 6144 on a closing basis, 6147 on an intraday basis, and we may get there today. We may not. We still have one more trading day this week, though. NASDAQ, really little change, but it had its gains. As we mentioned, NVIDIA hit an all-time high yesterday. NVIDIA itself currently down, but only 0.1%, so now it's worth less than $3.8 trillion, but I believe still more than Microsoft Microsoft, and more than Apple. Those are the $3 trillion companies. Micron falling as well. So we're losing some momentum with these companies falling. Shell is up after saying it is not in talks and does not basically want to buy BP, as had been reported. You have Walgreens, Boots Alliance, and Nike both gaining, but not doing a lot on earnings news. Katie, let's focus in on Nike.
Yeah, Nike coming up after the bell today, and those earnings are expected to move shares more than 7% in either direction. Bloomberg Intelligence senior retail analyst Poonam Goyal says that the company's turnaround could be at a turning point. She joins us now. So Poonam, this turnaround, let's talk about it a little bit, because Nike has seen 3 straight years of losses. It's down another 17% on a total return basis in 2025. Investors have been waiting for quite a long time here.
Yeah, you're absolutely right. The story for Nike has been very, very, sad, because you've seen them essentially lose $5 billion in top line over the last 2 years. Their shares have crumbled, and it's all because they have inventory that they can't sell. So what we're looking for today is where their inventory stands. Their inventory was down only 2% at the end of their last fiscal quarter, yet sales were down double digits. We need inventory to be down more, and that's what we're looking for today. But also the newness, right? So Nike has to reconnect with its shoppers. It has to bring more newness into the pipeline, and it's working on that. The question is, are we at the bottom today, and will we move up from here? And I think the inventory number will help us decide that in a meaningful way.
Nike is going to, I see on Instagram, Poonam, it's going to drop on Friday the Nike W Air Max Phenomena SWDC. This is like a sneaker, but also a loafer.
Ooh, a snowfer.
And it's horrendous, honestly. Does anyone expect this to sell? Who at the company made this decision?
Look, I think, they're trying, these drops are in limited quantity, right? You have to remember, when you're looking at these drops, they're not making millions of units. They are select quantity. It's for someone who wants to be different, who wants the latest fashion, the latest style. Some drops are going to go, to a far extreme, and some are going to be very popular. This may be the far extreme one, but it just shows that they're trying, right? They're trying, they're testing. And from what we know and from what we see, most of their drops have been very successful, especially the drops that they've had with the Kobe shoes. So I do think that they're making strides in what they're doing for the newness, but they have a lot of old stuff that they still need to get rid of.
Yeah, and I will note that those snowfers are $500, I believe.
I mean, they're part of the Serena Williams collection, and she
for sure
is a legend.
She is.
Plus, she has really rich friends, so maybe they buy all of them.
We have 30 seconds left with you, Poonam. What is the latest on the Skims partnership?
Yeah, so it's been delayed till later this year, and they've said that it has nothing to do with supply chain. We think some may be due to supply chain. It just may be, them not being able to get the product at the right price at the right time. Because remember, there is now a high tariff on goods from China. So Skims is being made in China, which is a big question to ask today. Then we do think supply chain does have some part in it.
All right, Poonam, great to get your take. We will always be looking at your research. Our viewers can do that as well by typing BIGO on the Bloomberg terminal. Coming up in the next hour, Liz Ann Sonders says retail traders are buying the dip to power markets. We also have the CEO of PayPal joining us, Alex Chris, on his firm's stablecoin ambitions. This is Bloomberg Open Interest. We are 30 minutes into the trading day, now bouncing back up with the S&P 500 at 6116. NVIDIA is swinging higher again.
Swinging higher, 30 points away, as you've been saying, from a record high. We're pretty close, Matt Miller.
Yeah, I'm Matt Miller.
I'm Shonali Bassick. Welcome back to Open Interest. It's a really interesting morning. Stocks shrugging off economic data, and it's game on for bank stocks because Wall Street firms could be set for a revival thanks to looser regulations and a delicate rise in deal making, Matt.
Crunch time. President Trump pressures Congress to quickly approve his big beautiful tax bill by an ambitious July 4th deadline.
And the president turns up the pressure on Jerome Powell again. Mary Daly of the San Francisco Fed spoke earlier on Bloomberg.
The people in my district are cautiously optimistic overall, thinking that the economy is weathering some of the worst concerns and the uncertainties, but continuing to move along. So cautiously optimistic is where they are, and I think that reflects what's on top of their mind, less about what's happening in Washington and more about what's happening in their lived experience in their communities.
All right, so that was Mary Daly, and we'll continue to bring you obviously more on the Fed, but I want to focus in first off on bank stocks and financials. I'm sure Shonali won't disagree with that.
Won't stop you.
Liz Ann Sonders joins us. She's Chief Investment Strategist at Charles Schwab. And Liz Ann, it does seem like there's a perfect storm brewing for these stocks as deal making is expected to continue to chug along and pick up, as regulation is expected to continue lightening. Certainly there are no new regulations that these banks have to deal with, and the interest rate environment stays high. What do you think about financials?
Well, we actually, back in March, we neutralized all of our sector recommendations. So instead of having some with outperform ratings, some with underperform ratings, some with market perform or neutral ratings, we moved everything to neutral, simply because we've seen so much short-term sector volatility from a leadership perspective, in part driven by all of the policy uncertainty. Getting probably close to the point where we may want to put those sector recommendations on, but for now, everything is neutral. Where we think you want to focus on, and this could be part of the reason why financials are doing well, is screening for and investing based on factors. And we continue to have an up in quality focus on factors. So strength of balance sheet, high interest coverage, stability and profit margins. And on many of those quality-based factor metrics, financials broadly, not across the board, actually look fairly decent. So I think even absent having a sector view, you get a decent amount of quality embedded in many of the financials.
The most recent rally Matt and Katie were talking about a little earlier was very contingent on a lot of the big tech stocks just rebounding. And I'm really wondering, I want to pull up this chart for you, Liz Ann. Our producer Dan Curtis shared it this morning. You have economic surprises to the downside, yet the S&P now back near its record. And if you have economic surprises to the downside, perhaps traders are betting more and more, and you see it in Fed futures, betting on rate cuts, which makes me wonder and wanted to ask you, how contingent is this rally on successive rate cuts?
So I have a bit of a contrarian view about this. I actually think one of the reasons, not the reason, but one of the reasons maybe why the market has been so resilient is because the Fed remains in pause mode. So I'm not sure that the market's rally is a function of believing the Fed is going to imminently step in and cut rates. I think it's confidence in the Fed, at least at this point, sort of digging their heels in, suggesting that neither side of their dual mandate is suggestive of much easier policy here. So, and this is, by the way, in part because given the instability right now from a policy perspective, all of this uncertainty related to that, I'm not sure the elixir to what ails us, particularly as we saw in a lot of the data today that had a little bit of that stagflationary tinge to it with the downward revision to GDP, upward revision to PCE. I think that the Fed doesn't have, based on their dual mandate, the push to ease policy. And for now, I think the market views that to be the right call, not to mention that cutting rates here isn't really the elixir for what ails the backdrop right now from an uncertainty perspective.
Liz Ann, you made the point that this rally has been powered by retail investors. They bought the dip and it's paid off. Yep. I wonder if they're also moving back into a 60-40 portfolio, because when I type INGO on the Bloomberg and look at these fixed income returns, they're pretty darn good. And you get obviously this a little bit more stability, and you clip in coupons. And what do you think about bonds?
So it's not just semantics, Matt, but you mentioned retail investors. And I think of the investor class, I think that there is intrigue with the level of yields you can get that are relatively safe. And it's been our focus. My colleague, Kathy Jones, who's our fixed income strategist, has said stay up in quality, kind of hug the benchmark in terms of duration within treasuries. But my point about what has powered this rally is retail traders. That may seem like semantics, but I think there's a difference between maybe I would call them individual investors and retail traders, that cohort that was born out of the pandemic. And you see their fingerprints on this move up off the early April lows via areas like retail favorites, one of the Goldman Sachs baskets, or meme stocks, the non-profitable tech area. So I think we should distinguish between those two. I'm not sure the retail trader I'm talking about cares probably a lick, if not much, about what's happening on the fixed income side of things. They are very much in that, buy the dip mentality that has served them well in the era they have become dominant, which is in this post-pandemic era. And I think that's where you're seeing the power. And data has shown that their weight within daily trading volume has leapfrogged the weight prior that had been at the top of areas like high frequency traders and quant and algo based institutions. So I think it's a cohort we have to continue to follow really closely because they have become much bigger power drivers of market moves.
What does that mean for the health of the market that you're seeing right now? If you had a rally that was so powered by people ready to buy meme stocks, ready to buy unprofitable companies, then how long could it last?
Well, that's, I think, one of the risks right now is that we're building complacency into the market structure. I still think the pain trade is probably higher because what the move up in the market has done a little bit later than when the retail trader stepped in to buy that intraday, April 9th low, is it's pulled institutions along with it. So one of the other areas that you've seen outperform on the way up has been the most shorted stocks. And that's ostensibly the institutions have been forced to cover. But if you look at positioning among the broad sort of cohort of institutions, I would argue they moved from being in a pretty risk-off structure in the early part of April to maybe something more in the neutral to slightly risk-on. They haven't gone hog wild to the risk-on side of the spectrum, which is part of the reason why the pain trade may still be higher. But I think we also have a setup that's one of heightened complacency and therefore subject to some downside if we get some sort of negative catalyst. And if I wanted to put a finger on what that could be, the important upcoming deadline of July 9th, which was the 90-day extension of or the delay of the reciprocal tariffs that were announced on April 2nd.
Downside hedges are expensive. Lizanne, what do you think about that move?
Well, I think there's a way outside of maybe options-based hedging to provide some maybe lowercase h hedge in the portfolio by, again, staying up in quality. Now, factors like low volatility and stability and dividend yield admittedly don't tend to be the outperformers when you're in the up part of the cycle. That brings back in factors like momentum. But where you do get protected in relative terms, as we've seen throughout the course of this year, from a factor standpoint, are in factors like low volatility. So that's a way, without going to the extreme, into the options market, into expensive hedging options, to provide a little bit of that quality diversification within the equity portion of the portfolio.
Lizanne Sonders of Charles Schwab, we thank you so very much for joining us this morning. Of course, just points away from a record high on that S&P 500. Let's look under the hood, though. Let's look at some single stocks moving this hour. Micron issuing an upbeat forecast helped by demand for AI equipment. It's now down, though, Matt, about 1.4%. But we have to remember Micron was actually one of the best performing stocks, the second best performing stocks in the S&P 500 over the past month. But Nvidia is still on the rise.
Yeah, so it looks like investors taking some profits from Micron, which is, to be fair, a much smaller company than Nvidia. Back on the rise. It had a real swing in the past 20 minutes from negative to a gain of almost 1%, which for a $3.8 trillion stock is meaningful.
Yeah, absolutely. Almost 1% higher, helping power the market rallying back up to what might be another record. Now, coming up next, we're going to talk to the CEO of PayPal because college athletes are about to get paid directly on the heels of an NIL takeoff. He's going to talk about how PayPal is stepping in to power a historic shift. in college sports. This is Bloomberg Open Interest.
Getting out of high interest, look at what's making headlines around the world. Iran's supreme leader, Ayatollah Ali Khamenei, is claiming victory in the war with Israel, saying U.S. intervention achieved nothing. Khamenei warned that Iran could repeat its attack on U.S. bases if any aggression occurs. His comments come amid conflicting assessments about the effectiveness of those U.S. strikes. Consumer products giant Mars is facing headwinds in its bid to acquire the competitor Kellanova. The European Union has opened an in-depth investigation into Mars's $36 billion bid for the maker of Pringles chips, Rice Krispies, and Cheez-Its. Meanwhile, the U.S. Federal Trade Commission has approved the takeover, finding that the deal does not meet the standard for an anti-competitive merger. And the Federal Reserve relaxed plans it is going to relax a key rule which would reduce capital requirements for big banks. Shanali is the expert on this. This allows the banks to hold more treasuries and act as intermediaries in the $29 trillion market. Bloomberg reported on the potential relaxing of the rule last week. Is this the SLR thing?
Sure is.
Yeah.
We will talk much more about that soon in this hour. But for now, we're going to switch gears. We're going to go to another financial company that's also dovetailing with the world of sports. It's a new era in particular for college sports. A federal judge has officially cleared the way for schools to directly share athletic department revenue with student athletes for the first time. And so today, PayPal announced partnerships with schools across the Big Ten and Big 12 to distribute payments to student athletes. Joining us now, PayPal President and CEO Alex Chriss. And it's interesting, you have been saying since you got the job that innovation was going to be a big part of it. When you bring on a whole new host of students to the platform, how does this help PayPal grow?
Well, it's great to be here today. And look, the reason this is such an exciting partnership is these student athletes are already our customers. There's 19 million college students in the United States. Over half are already using Venmo, and even more if you add PayPal on top of it. So over a year ago, we started talking to the Big 10, the Big 12, and we'll be working with all of the other conferences to figure out, okay, how will they actually distribute these funds when this ruling comes down? And so we're very excited to be the platform that they chose for the safety, the security, and the ubiquity that PayPal and Venmo bring to these college campuses. So it's an incredible partnership. It allows us to put dollars directly into college students' pockets in the wallets that they use every day. They're already using Venmo to be able to go out to lunch and split the bill with their friends, for their parents to be able to send them money, to be able to pay their rent, and soon to be able to pay their tuition. So we've been innovating. We're leveraging the technology that we have at PayPal to be able to make this partnership happen.
I mean, Venmo is everything, Alex. Just everything for the kids and for the adults. I mean, my friends who are 50 years old are using this for the same reason. It's just another level. And you've managed to avoid the pitfalls that Zelle has found itself in. How do you move forward in really monetizing, really taking advantage of that momentum?
Well, we do think we're building the financial application for the next generation. And it was very clear when I got here that Venmo was ubiquitous. It was the verb for how people moved money. But we needed some innovation. And so we started with ensuring that the money that came into a Venmo account, our users could be able to spend. So our Pay with Venmo card, which is a debit card, which is part of this partnership. So now on all of these college campuses, students will be able to have a branded debit card to be able to show their pride. Alumni will be able to get it as well and show their pride. So a debit card to be able to pay with their Venmo balances, Pay with Venmo button for e-commerce. And we're seeing tremendous growth through both of those. That's how we monetize. Being able to we have $18 billion of funds that move into the Venmo ecosystem every month. We just need to enable our users to be able to spend in the wallet that they know and love.
What could you tell us about how fast Venmo can be growing in the future? You're announcing these new initiatives. You are saying right now how much these students mean to you and how much they could increase adoption on college campuses. But at the end of the day, what are growth figures that could show any signs of how these initiatives are taking off?
Well, look, our customer base continues to grow. Even though we are ubiquitous, our customer base continues to grow. And now we're starting to see the monetization levers kick in. So Pay with Venmo grew 50% last quarter. Our Venmo debit card grew 40%, and overall revenue grew over 20%. And so this is just starting to see our innovations kick in, and I think we're in the early days of this new trajectory.
Speaking of early days, I want to ask about PayPal ads. I believe it's less than a year old right now. How is that investment benefiting your overall payments ecosystem? And why ads now?
Well, look, this is a part of our whole transformation of going from a payments company to a commerce company. This is our ability to leverage an end-to-end experience with our merchants. When I talk to our merchant partners, they obviously want to use us for payments, but they're really interested in getting in front of customers. They're really interested in knowing their customers better and being able to personalize the experience. We have that customer data, and our customers have opted in. They have been part of our customer ecosystem and said, yes, we trust PayPal with our data to be able to share that in a responsible way with merchants so that we can provide a really personalized experience. And so being the owner of a two-sided ecosystem, we have to take advantage of that. And PayPal Ads is a great example of what we're moving there. You've seen some of the announcements that we've come out. Even just last week, we announced our ability to have an ad that is actually shoppable. So now merchants can actually have an ad where the user can click and actually buy right through that ad. This is changing the game for commerce and connecting merchants and consumers in an unprecedented way.
Alex, while we're talking about young people, college campuses, they're very interested in not just crypto, but also stablecoin and what stablecoin can offer as a method of payment. Now, our colleagues at Bloomberg Intelligence point out that you were actually the first major mainstream financial company to launch a U.S. dollar-backed stablecoin almost 2 years ahead of the pack. And when you think about all the others that are trying to do this now, JP Morgan, maybe even Walmart, what are you seeing that other people might not be seeing when it comes to the potential for stablecoin to back the payments infrastructure of the country or even the world in the future?
Well, I love this question. We were doing stablecoin before stablecoin was cool. So we launched PYUSD over a year ago, and we're now, to answer your question, what I'd say is beyond the hype, we're actually putting real use cases into our customers' pockets. So whether you're on Venmo, whether you're on PayPal, whether you're a merchant, you can now convert some of your holdings into PYUSD and earn 4% rewards. So we're putting money back into our customers' hands. You can use crypto to be able to make purchases on any of our PayPal merchants through our PayPal wallets. And so we're actually creating real use cases for our customers beyond just the hype that's out there.
And how much are you seeing in terms of adoption of this stuff? Because we hear so much about it from, Kaylee Lines on Balance of Power talking about the genius legislation, but I don't think that Shonali and I are using stable coins on a regular basis yet.
I'm still using the traditional way, dollar-to-dollar payment.
There you go.
Yeah, look, here's the reality. We were a big part of the Genius Act. We were helping shape that, so we're very excited about the future of stablecoin. The reality is the first use cases are most likely to be cross-border transactions, right? When you're moving money and you're paying large fees for cross-border transactions, that's an opportunity to have a fast, secure, and inexpensive mode of currency, and I think we will be the leaders there from a stablecoin perspective. Domestic payments right now, you know what? They work. And from a consumer standpoint, there isn't a real incentive to drive adoption, which is why we're starting to create things like rewards and starting to incentivize users. And we'll see where that leads to. But I think it's likely to be a longer road for stablecoin adoption domestically. And I think you'll see acceleration on cross-border transactions, and especially folks outside of the United States that want to hold US dollars. And it's just very difficult. Stablecoin opens up that opportunity.
Alex, congrats on the Big Ten announcement today. That is Alex Chriss, the CEO of PayPal. We're looking forward to talking to you again soon. Now, still ahead, we're going to talk more about financials because you're right, Matt. They are really catching some attention today. Jefferies, for example, the profit's actually slumping on weak deal making. So for all that excitement, we're going to talk about what all this means for the Wall Street bank earnings that are coming up in just a couple of weeks. That is in red on my calendar. We'll talk more about it in a minute. This is Bloomberg Open Interest.
All right, we are still quite a ways away, I guess 30 or 40 points away from a record high. And you can see from this move screen that the S&P has taken a move down. But we're still looking at 354 gainers, 147 losers. So the breadth is there. NVIDIA and Facebook, Broadcom leading the way, Apple and Equinix going down here. In terms of what we're seeing in the sectors right now, almost every sector is gaining. The only problem really is real estate, but consumer staples are down as well, Shonali, which I think is fairly interesting because then people aren't playing defense today.
Less than 20 points, 25 points away from that record high. But stick with us. We're going to talk about infrastructure next. We're going to bring in American Water's CEO. Stick with us. This is Bloomberg.
This week's heat wave was another strain facing the nation's water supply. In a recent op-ed in Newsweek, American Water CEO John Griffith outlined the harsh reality. The infrastructure for our drinking water and wastewater is crumbling, and John Griffith joins us now to talk about it. So, John, you know, this is one of those things that I've been hearing about for most of my life, that we need to really start to worry about water, that we can invest in water. And is that now going to become a reality? Are we starting to get to the tipping point, so to speak?
We are, Matt. There was a lot of federal capital invested in our water infrastructure and wastewater infrastructure back in the 1970s with the Clean Water Act and the Safe Drinking Water Act. Since that time, municipalities really haven't had the opportunity to invest a ton of capital in the system. So there's a lot of deferred investment, a lot of deferred maintenance. They're increasing environmental regulations, as you might be aware, for water quality. So there's just a lot of investment that needs to be made. The American Society of Civil Engineers gives drinking water in our country a C- rating and wastewater a D+ rating. So there's just a lot of capital that needs to be invested.
John, something that Matt and I talked to a lot of investors about on this show is the tax bill and the kind of strain that's not actually just on the nation's finances, but on state finances that could be exacerbated. Now, if states face a bigger cash crunch, then how troubled is their infrastructure investment spending at the end of the day?
Yeah, it just makes it harder and harder. You know, the states have competing priorities. And really, we operate and we see it at the municipal level as well. You know, a lot of municipalities have debt, underfunded pensions, needs for capital other than water infrastructure. So they tend to just let it lag year by year.
What is the specific infrastructure that's really problematic? You're, I guess, not talking really about climate change, or we haven't gotten into the drought conversation yet, which right now, you know, it's been raining every day for this year. But but what about the actual, you know, network, the way we move water around?
Yep, and that's the business that we're in. So we're American Water is the largest water, wastewater utility in the country. We're in 14 states. We serve about a population of about 14 million people, in addition to 18 military installations. It's about water treatment and then transmission and delivery of treated water, and then also wastewater collection and treatment as well. That's really what we do. You know, it's hard to dig up the ground, put new pipes in the ground. In our own network, we've got about 55,000 miles of pipe under the ground. Every year, we invest in about 450 miles. So it's just an incredibly slow turnover of the system. And frankly, we're fast. We're kind of market leading in that regard. It's expensive to dig it up and to put new pipe in. And that's what you see at the municipal level as well. And then on top of that, there are federal EPA PFAS regulations, lead and copper regulations that also require immense amounts of capital. Water supply is a separate but related issue. In most of our jurisdictions in the eastern half of America, there's good water supply and that can be managed. We've got operations in California and Hawaii as well. California, we're developing a desalination facility, which can be useful. Some states just have a difficult time capturing and retaining and storing rainwater and other sources of water. So that's where we start to see those kinds of constraints.
Now, John, something that's interesting, and I also want to say it's a really interesting year for you taking over as the CEO. The stock for American Water is starting to rebound from a 3-year-in-a-row decline for the stock price. And at the same time, despite all the kind of very capital-intensive projects you're talking about state by state, you're investing. You recently made an acquisition, and an analyst recently asked you, with the pressures you're seeing on different states and the infrastructure in them, are you willing to invest more? Are you willing to do more acquisitions to grow your network?
Yeah, we are. We invest organically and inorganically or through acquisition. We'll be investing $40 to $42 billion over the next 10 years. About 10% of that will be acquisitions. The vast majority of it is just good old-fashioned infrastructure renewal. And water is a sector, when you think about it, there's just not a lot of opportunity for technology substitution, right? You got to, you got to treat the water, and you got to be able to deliver it. It's a pretty basic business in that regard. We really think it's a strong point for our sector, for water and wastewater, and for our company. We invest in a very growthy way. We talk about our rate base investment. Rate base is what we earn on as regulated utilities, growing that at 8 to 9% over on a year-by-year basis, on a CAGR basis over the long term, and earnings by 7 to 9% over the long term. And it really goes back to just those basic needs of system needs that are so underinvested today.
Hey, and what's your take on the regulation? I mean, if there is a regulator holding prices down, that skews, obviously, the market. How much would water cost if that weren't the case? What's your take on that?
Yeah, the regulation at an EPA level, at a federal level, is necessary regulation, and it really goes to human health. This is water quality. So PFAS in the water, which are commonly known as forever chemicals, right, from consumer products and end up in the water streams. Lead and copper need to be worked on. So those are incremental costs.
But I was thinking more about the price, John, because if water, I mean, it's obviously a very valuable resource.
Yeah.
I mean, I pay a lot if I fill up the pool, but I don't pay that much if I'm just drinking it out of the tap and using it.
That's right.
So how much should I be paying for it?
Sure. Well, the water that we deliver, you're not paying for the water itself. So a utility like American Water, we have allocation rights. Let me say it differently. Outside of certain Western states, but by and large, we pull water out of the environment. We treat it. We deliver it. It goes back. We treat it again. It goes back into the environment. The cost that you're paying as a customer is really the infrastructure cost and the operating cost. It's the return on and the return of the capital that we invest.
John, very good luck.
So there's not a markup on the water per se, or even a cost of the water.
Well, we're watching the cost of all utilities very closely right now. John, we thank you so much for your time and for joining us today. That is John Griffith of American Water on his investment plans. Let's get a check on these markets now because, of course, we are so close to that record high. I believe we are less than 20 points now, Matt, away from that S&P 500
Yeah,
record.
I'm not good at math, but 61.44 is the closing record. 61.47 is the intraday high. Obviously, it doesn't really make a huge difference, but it's a number that we're looking for, a milestone that we're watching closely. So, and I think a lot of investors are watching as well.
Yeah, absolutely. And the question is, how far can you break away from that? The bond market also still on a tear. We haven't been talking about it, but 426.
I have been talking. I've been looking at IN Go also. So not just WB Go for the treasuries, but IN Go will show you year-to-date returns on any of these indexes where we haven't seen returns for the last, 10 or 15 years.
60/40 is back, at least for now.
That's right.
going to look at some single stocks moving this hour as well. I know you guys were talking about it a little earlier. Walgreens is higher after quarterly profit beat expectations. McCormick also higher. Its outlook is easing investor concerns.
A $20 billion spice company.
Spices are delicious. What can I say? I use all of them for everything I cook. Some people are too boring. Salt and pepper is not a lot.
But does it make a difference? Like, is there a difference between McCormick's cumin and the cumin, like, at Bowl and Basket?
You mean besides the price you pay? I loved Isabel Lee's comment a little earlier. The glass you pay for what it's stored in. This is why you go to the Indian store and buy it in bulk. Anyways, we are going to go on and move over to banking as well, because Jefferies is reporting a second quarter decline in earnings as market turmoil weighed on the firm's investment banking and capital markets business. We watch Jefferies closely because it is a bellwether in a lot of ways to what the banks are doing, and it brings us to our Wall Street beat. For more on Jefferies, we are joined by Bloomberg finance reporter Catherine Doherty. You know, Matt and I were looking this morning on how Jefferies was doing relative to the banks in the last 5 years. They are outperforming massively, so watching a little bit of cool off is not a big deal. But how are bankers now watching their performance and seeing what they might have to put up in the next quarter?
So it's kind of a tale of two cities. You have deal making, which has cooled. That's on back of uncertainty and all the turmoil that we saw really to begin 2025 and in the first 2 months of the second quarter. But what Jefferies is saying is that uncertainty, they're starting to see some path towards clarity. And what that might signal for the banks going ahead is that we will see momentum potentially start to build, which is what the entire 2024 narrative was, is that deal making was starting to return. Eventually, everyone thought that the beginning of this year was going to be a continuation of that on back of a new administration, lighter regulation. But because of all the uncertainty, we really didn't see that. So Jefferies' results is showing that deal making has really not come back in the way that analysts and Wall Street bankers themselves expected. Now, on the other side of this, trading has benefited from the volatility, specifically in the equity market. And that has impacted underwriting. So you see equity and debt underwriting performing differently, one outperforming the other. But what really I think was interesting is not just the results that Jefferies put out last night, it's their indication of what is ahead. And that is what we'll also be looking out for when the big banks start to report next month.
I was a little confused at the Jefferies report because at the same time as I was reading that, I saw Mike Mayo's comments on the triple play, right? Mayo, who is, I guess, talking about the bigger banks and not these capital light boutiques, is pointing to deal making, maybe deal making to come, looser regulation and a high interest rate environment. That's why he says, like, giddy up, you know, which I love. So is deal making back or is it on pause?
I think that the expectation is that it will come back, but we're not seeing that just yet. So tomorrow we have the Fed's stress test coming out. That is some of the indications that we're going to look for in terms of the lighter regulation. And if that does come as expected, you might see deal making and these banks start to put their capital to work in a different way than they have been able to in the past. So that's what Mayo and other analysts are expecting in terms of the momentum to start to build. You see lighter regulation, you see more capital formation. And as Jefferies had said, it's not just about the banks, it's their clients that they're talking to. They're saying that the discussions they're having with folks in the markets around capital formation and strategic opportunities, that discussion is increasing over time. So the question will be, does it actually come to fruition?
Well, I'm not as good at terminal charts as Matthew Miller, but I have one to pull up to show kind of where the rebound is coming from. If you look at MA Go on the Bloomberg terminal, you go over to the time series, you can see that first and second quarter deals for this year are higher than when they were a year ago, but well off their highs. And here's the problem. If you're a bank like Jefferies, you're heavily weighted to the private equity firms where deals have not yet really come back. So in that scenario, wouldn't actually a Bank of America, a Goldman Sachs, a Citigroup actually kind of do better because they're dealing with these big corporate strategics?
Yes. However, the big corporate strategics are the ones that are having to make these decisions about how they react to, for example, the tariff negotiations. When these sorts of things, these big question marks aren't resolved, those big corporations, you're not likely to see them make big moves or make big deals until that uncertainty starts to clarify itself. But what I will say on the flip side of that is that you're starting to hear from corporate America that uncertainty, they're able to digest it in a different way. So that is also what Jefferies executives are saying. They're saying that their clients, even if it's not some of the bigger corporations that you're referencing, they're starting to be able to just move forward, even if there isn't complete certainty in the path ahead.
Giddy up.
Yeah, giddy up. All right,
up.
Cato, great having you on set. Thanks so much for joining us. Catherine Doherty covers Jefferies for us. Coming up, the U.S. Treasury is working on a deal that could make the so-called revenge tax irrelevant. We'll bring you the details on that. Maybe we'll talk about SLRs
Yeah, we will.
as well.
We will. Hot word these days.
This is Open Interest.
Now, while Republican lawmakers continue to hash out the details of President Trump's tax bill, the Treasury Department is nearing a deal that would make the so-called revenge tax irrelevant. That could bring a big sigh of relief to Wall Street investors who have been worried about punitive tax measures on foreigners who are, of course, large buyers of treasuries. Joining us now from Washington is Daniel Flatley, Treasury reporter for Bloomberg News, out with an interview with the Deputy Treasury Secretary, I believe, too. Daniel, there have been so many ways that the Bessent Treasury has been trying to ease the pains in the Treasury market. How would their fixes offset any issues tied to that feared measure, really, with $8.99 in the tax bill that could have otherwise made it difficult for foreigners to buy treasuries?
Yeah, it's a great question, and I think there's been a lot of activity, obviously, here in D.C. over the last several days as this tax bill makes its way to the Senate floor, hopefully sometime this weekend. And then eventually, the timeline is that President Trump wants to sign it by July 4th. But one of the things that we're looking very closely at is this Section 899, which some people refer to as the quote-unquote revenge tax, because essentially what it's trying to do is basically charge a tax on foreign investors who are on their U.S. income in an attempt to get other countries to lower some of their taxes on U.S. firms, including some digital services taxes. And our understanding at the moment is that there is a deal in the works potentially with several countries that would basically obviate the need for that provision to be in the tax bill. And also the deal itself would have some implications for both U.S. firms and foreign firms. And one of the folks that I spoke to yesterday was a manufacturer here. It's a Norwegian-based manufacturer who has operations here in the U.S. who basically said, look, this would be terrible for our business, this Section 899, because it would result in an increased penalty for us to invest here. So I think that lots of folks are kind of watching this very closely in terms of not just implications for business activity, but also investments and other things that they may be looking to do both here and abroad.
So, Dan, is this a deal that would make the revenge tax irrelevant, or is this a deal that would allow Congress to remove Section 899 from the bill?
Well, if you look at what Deputy Secretary Michael Faulconer said yesterday, he used the words irrelevant. I think, Kevin Hassett yesterday was talking about potentially taking it out of the bill. If you take those two comments together, I think it's safe to assume that what we're talking about is removing this provision from the bill at some point, assuming that this deal comes through.
All right, very cool stuff. Great reporting. Daniel, thanks so much for joining us. Bloomberg's Daniel Flatley out of Washington, D.C. One piece of this very big, beautiful bill that we're going to talk about. Another is the Republican plan to cut $250 billion in Medicaid and other health care spending. It's hit a roadblock in the Senate. Balance of Power co-host Kayleigh Lyons joins us now for details on this one more piece that's maybe problematic. Kayleigh, how is this going to work itself out?
Well, that remains to be seen, Matt. This is a ruling from the Senate parliamentarian Elizabeth McDonough, who essentially is charged with deciding what can and cannot constitute pieces of this reconciliation process, because that is the process Republicans are using so that they can pass this along party lines, budget reconciliation, and not everything can fall under that umbrella. And she has ruled that indeed two of these healthcare-oriented proposals, one that would limit states' ability to tax providers in order to fund Medicaid, another that would basically punish states that use Medicaid funding of their own in order to help fund health care for illegal immigrants. Those things cannot be included in reconciliation as they're currently written. And on one hand, that could actually help the odds of this passing in the Senate, as there had been a number of senators, from Tom Tillis of North Carolina to Josh Hawley, Republicans, both of them, who had suggested they were very concerned about the impact that provider tax language could have on rural hospitals specifically. But on the other hand, because as you just suggested, Matt, this was supposed to help save some $250 billion, it could make it a whole lot harder for this ultimately to pass the House once again, as there are plenty of fiscal conservatives in the House who already felt that this big, beautiful bill did not cut spending enough. And if you take the price tag up by taking out some of these things that were supposed to be offsets to lower taxes, that could make this a whole lot more complicated, not to mention could extend the timeline, as the Senate was going to try to start votes on this tomorrow. And if the Senate is now going to be trying to rework some of this language to make sure it can still be in the legislation, it could set things back by a bit.
Yeah, and we haven't even gotten to the SALT cap that, New York and New Jersey congressmen have already capitulated on that, and the question is, would they go even further? Kayleigh Lines on Balance of Power at 1 p.m. and 5 p.m. Again, don't miss that program on Bloomberg Television. Today, guests include Democratic Senator Jeanne Shaheen of New Hampshire. And then, so there's so much complication with 1B3. Yesterday, another wrench gets thrown into my works with somebody talking about SLR. What kind of regulation is this?
Yeah, the quick way to learn about this, the SLR is the supplementary leverage ratio. This is a capital charge that is applied to banks on Treasury holdings. The Fed is looking to reduce that capital charge to make it easier for banks to hold Treasuries. And maybe this would ease some of the strain on the Treasury market, perhaps. That's why they want to do it. But, Matt, there are still doubts out there because, remember, the Treasury market has been very, very volatile.
Right.
So whether this will actually bring down long-end rates, that's the million-dollar question.
Right. Well, that is the plan. And this, obviously unrelated to the one big, beautiful bill, is just another mechanism to lower yields. They're already very low, right? We're looking at a 10-year yield of 4.267%. This is Bloomberg. Welcome back to Open Interest. We are looking at a market that continues to hover below its all-time high, but we're not so far off. You can see 61.27, the level there, so just 20 points below an intraday high, a record high of 61.47. And it looks like this market wants to get there, right?
We are so close. And it's interesting. You're seeing other parts of the market ripping, too. If you blinked, you might have missed it. The Philadelphia Semiconductor Index, where a lot of those semiconductor AI-heavy names, is now up 11% on the year. So finally, tech leading the charge once again.
Yeah, exactly. I mean, it is NVIDIA that's added $1.5 trillion in market cap since April. At one point today, it was up 1.5%. If it does that again, if it gets back to its daily high, that will push the S&P to a high as well. Coming up tomorrow, Kate Moore joins us from Citi, as well as the president of Amtrak, Roger Harris, to talk about your commute. This is Bloomberg.